Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking with Vitaliy Katsenelson. How you doing today, Vitaliy?
I'm doing great, Kirk. How are you?
Good. We're glad to have you in the show. I'm a big fan of your work, and I wanted to bring you on because I know the listeners will really benefit from your wisdom. So maybe you can tell us a little bit about your background just to get the listeners up to speed.
Sure. Well, let's see. Let's start with my accent. So I was born in Russia. I moved to the United States in 1991 with my whole family, and I lived in Denver since. I have an undergraduate and graduate degree in finance. I'm a chartered financial analyst, and I basically been an investor since 1997, so almost going on 25 years. I run an investment firm in Denver, a value investment firm in Denver called IMA. And we basically manage money for high net worth individuals who, trust us with their life savings, which is a huge privilege. And in addition to investing, I have this hobby that's became a very important part of my life is writing. So I write. I've written articles from Financial Times to Barron's to Institutional Investor Magazine, and I wrote a few books. My first two books were on investing. My last book, which is coming out in June, is not on investing, and it's called Soul in the Game: The Art of a Meaningful Life. And that book has to do with absolutely nothing to do with investing, just life topics. So that's basically kind of Vitaliy Katsenelson in a nutshell.
Okay. Well, we'll get to the book at the end because I love talking about that. We could probably even have a whole separate podcast episode on that, A Meaningful Life. So I guess let's kind of dive right in. So you're a value investor, and I would imagine the last 20 years must have been a little challenging to be a value investor, given the environment. So tell us a little bit about, how you've been able to kind of manage that period, which is kind of abnormal in the historical context for value investors. Like, how has that been for you?
Yeah, well, so let's just go back the last 20 years. I think the first 7-8 years of the decade were actually very kind to value investing. Then we had it was kind of neutral for a while, and then last 5-6 years it was very difficult, because if you think about value investing, it's a very commonsensical, rational investing. In other words, the way I make decision is not much different from a dentist who's looking to buy a practice and he's trying to figure out how much to pay for it, or a farmer who's buying a cow, or it's just a rational businessman who is analyzing the business. So value investing is basically commonsensical investing. However, in the environment when interest rates are incredibly low and people are basically high on high and low interest rates, the valuations get stretched out, and the common sense becomes, and they become indifferent to how much they pay for companies. It's not that value investing becomes difficult. It's just the type of companies I'm looking at, I would like to own that are, high quality companies that are undervalued. Nobody cares about them. And the companies that are maybe good companies and maybe even fast growing companies, those companies just go up in price every month, every year. And the issue is that we're in a business where people look at their returns and they look at the returns of their neighbor and they say, "Well, my neighbor bought Snowflake and it's tripled. And what have you done for me lately?" So luckily for us, we have clients that come to us for the common sense, and they understand that at some point the euphoria ends, and usually ends in tears. And I think that's what basically has been happening in the last 6 months to a year. Yeah.
Yeah, I mean, I think pretty much since 2008, people have been focused on growth stocks, especially in the last 2 years, right up until this year, which obviously is we're seeing some revaluations. But let's wind the clock back to like December of last year. You have a ton of companies which are way overvalued by almost every metric. I mean, the issue isn't whether you can find value. I do want to get to that. But the issue with individuals is, how do you justify value compared to growth when everybody is making money hand over fist with growth? And, the returns in the short term aren't equal. So how do you kind of have those conversations with people?
Well, I'm kind of fortunate is that the way the IMA has been built is that people seek out us. So we don't we don't go out and try to convince somebody to become a client. The way we get clients is people read my articles or read my books and come to us and say, I can relate to the way you do things. I would like you to manage my money. So that makes this conversation much easier, because if I was buying snowflakes and and Pelotons, whatever, clients would come to me and say, you're not doing what you promised you would do. So that makes it easier. So and also I guess that's why when the stock market was bubbling up, we were basically, I slept well at night because I knew my clients would be fine with us just doing a rational thing and just the problem is this: you never know when the music will stop, right? And you could have thought the music would have stopped in 2019 and 2018, and then you would have thought the pandemic would have ended the music, and it didn't. It just inflated the bubble, tripled the bubble, right? So staying rational when everybody else is irrational requires for you to be disciplined and having the right clients. So, and we were lucky about both.
Okay. Yeah. I mean, that makes a lot of sense. So staying in that kind of clock wound back time frame, how do you find value in periods like that? Like when everything is overvalued? Value?
I would get people, when we would talk to a prospect client and he says, well, the market is very expensive. I'm very nervous about buying, kind of owning the market. And I would tell them that you should be nervous about owning the market. The good thing is we don't own the market. And just think about this. In US, I don't know, in the US, there are maybe 5,000 listed companies. If you look globally, like let's say Europe and some other countries to it, let's say we go to 10,000 companies. I only need 30. So I will only own about 30 stocks, right? So my job is to analyze one company at a time and to find high quality companies, which you can find, by the way, you can find high quality companies in any market. And then the second thing is I want them to be undervalued. And that's where it gets difficult. But again, finding 30 companies that are high quality undervalued is not impossible, but it's sometimes it's still difficult. So when a new client comes to us, at times they have cash. So, and today, if you get new money, we would probably only going to be 75% invested, and we would still have about 25% cash. And over time, as the market presents opportunities, as it has over the last couple of months, we just put the cash to work.
So you talk about high quality and undervalued companies. How do you define high quality? Like, what do you look for to make sure they're high quality?
Yeah, I'll give you a couple of definitions. Warren Buffett likes to use one. Would you feel comfortable owning this company if the stock market was closed for 10 years? See, because the problem is investing in the stock market is that you have this daily liquidity. And this daily liquidity means your commitment to your decisions is kind of very light because, well, I can reverse it tomorrow. And so a lot of times you start compromising on your decisions, because I'll just pause for a second. If you were buying a private company, the liquidity is very different, right? You make a decision and it's a commitment for a long time. So we try to approach our investments as if we are going to buy it and then we can't sell it for a long time. And so that's the attitude we take. So once you start thinking about companies from that perspective, it changes what the quality means to you. So when we look at quality, we can basically break it up into kind of three buckets, three categories: a business, balance sheet, and management. Company's business basically is that a company that has a significant competitive advantage, has high return on capital, has high recurrence of revenues? That to us means it's a quality business. Balance sheet is basically, does a company have too much or too little, too much debt? And that number is going to be different based on the type of the business. So for instance, we own pipeline companies, and those companies have very stable, high recurrent revenues. Therefore, they need to have more debt. They have more debt, and that's fine. Then we own companies that have a more volatile business, and therefore they need to have either net cash or no debt. So it depends. And then finally, the management. And to be honest, this is where my thinking has changed a lot over the last decade. In the past, to me, this was like I spent most of my time thinking about the business, the balance sheet, the valuation. But now I think a lot more about management, because what I found is that the management is that little X factor that determines how well I sleep at night. Because if I have a company that's run by people who own a lot of stock, who truly have a soul in the game, which is kind of funny. That's the name of my book, but that's why it's the name of my book. But people who really care about the business, then that's in the long run is going to make all the difference in the world. And so when we look at management, we look at how well they run the business and how well they allocate capital. And when you come from the business world, capital allocation is not something usually people pay attention to. But actually, when you own a company like a larger size company, capital allocation becomes incredibly important, because with just one side of a pen, company can go out and spend tens of billions of dollars and destroy huge amount of shareholder value. So we spend a lot of time thinking about it as well. So business, balance sheet, and management, that's all together. That's where quality comes from.
So, balance sheet and business are a little more straightforward. When you're looking at management, like, what characteristics are you looking for? And is there an easy way to do that? Or is it just getting to know them as people?
Well, that's a good question. You look at the track record. So you look at what they have done, so which is important. You also we talk to management all the time. We also listen to conference calls, to the presentations, how they think about, we look at how they think about the business. We listen to these cues. Are they kind of short-term oriented, or they're just trying to be the quarter, or they're trying to build a sustaining business for a long time? I remember, we own the company. I'm not going to mention the name, but we own the company, and the company was run by CEO who everybody very respected a lot. And then there was a scandal, and CEO was fired, for unrelated to the kind of core business reasons. And then maybe 6 months after he left, the business fell apart. And everybody said, "See how great he was." He left, and the business fell apart. That's why you needed him to stay. And I would argue the opposite.
Yeah.
He did not, job of CEO is to make sure with every decision he makes, to increase, to make the business more sustainable. So when he leaves, if everything falls apart, it means it was, the company was built on kind of quicksand.
Yep. Yeah, no, I see that a lot. It's probably one of the small things that people don't really look for. It's the sustainability. Without a good CEO is somebody where a company can be run without him or her, right? They've created such a structure that they don't actually need them. So
yeah, I would argue like Jack Welch went into history books as this incredible CEO, and I'm sure there's a lot of things we could learn from him, but he has not built a sustainable company, because it fell apart, and
yeah. So now, when you're looking at I know I think you mentioned you went to Omaha for the Berkshire
Mhm,
annual shareholders meeting. Have, I assume you've gone there for many years, right?
mhm.
What have you kind of taken away over the years? Because the way I've kind of seen is Berkshire has changed a little bit, or Buffett's, I guess the way Buffett's looking at things has changed. So how has your perception been of Berkshire and Buffett over the years?
Oh God, there's so many things I can say here. Number one, this is the kind of the irony of this. You don't go to Berkshire Hathaway meeting just for Buffett and just for Berkshire. And if like, so I've been going to Berkshire meeting for last, I don't know, 11, 12 years, a long time. And let me see. First of all, like it's very, just imagine, now, Omaha is a relatively small town, right?
Yeah.
And then 40,000 people come in this very kind of for this weekend in late April from all over the world. Okay. And you have 40,000 people pack this huge arena. Like, I don't know, like, they have a college basketball games in this arena. Okay. And there's all these gigs pack this arena, and you have two guys, one is 91, another one is 98, sit on this stage for almost 6 hours straight. They take a break, an hour break, and answer questions. It's just absolutely incredible. What's really amazing about this event is that because so many people come in one place, it actually, it kind of becomes its own ecosystem. You have all these different events happening before, a couple of days before and a couple of days after the annual meeting. And so also as a value investor, I have a lot of value investment friends, and this is my time to actually meet my friends that come from all over the world. I have a friend from Germany, a friend from UK, and from Switzerland that will have dinner with, lunches or breakfasts. So it's a lot, so a lot of it is actually the social element. So let's talk about Berkshire Hathaway. Like, speaking of somebody who is looking to build a lasting franchise, that's Berkshire Hathaway, right? That's what Buffett is focusing on. Every decision he makes, he wants to increase the moat of Berkshire Hathaway. That's the right way to make decisions. As you know, and you can see why Buffett is doing it, because for him, that he, again, he has soul in the game. For him, that is his Sistine Chapel. That is his life's work. That's his legacy. So Berkshire Hathaway, a good thing about Berkshire Hathaway, that it's going to last a long, long time after Buffett is gone. How Buffett has changed. Well, let me give you this one little anecdote, because I think it's very, very important. A lot of times as investors, we make a mistake of trying to copy what other people think. Like when we have somebody we idolize, but we should really look at how they think, not what they think, but how they think. One example, for a long, long time, Buffett said, I don't know in technology stocks because I don't understand them. And I cannot tell you, this is like, if you met a value investor, a lot of times they say, well, I don't know in technology stocks because I don't understand them. They just basically copied Buffett's thinking. Well, the thing is, Buffett was 30 or 50 or 60 years older than that investor. And he grew up in a different era, and he had certain circle of competence. But Buffett's circle of competence does not have to be your circle of competence. Okay. And the irony of this, Buffett said it for a long time, and then he spent, I don't know, $10 or $15 billion on Apple stock. Okay. And that, by the way, I think it's probably the most successful investment Buffett ever made based on the amount of money in dollar terms, not return, but dollar terms it made for him. So guess what? Buffett has changed as well. So we evolve. So I think that is a great lesson. I mean, I think there is a lesson in it right there. What else I can say about this? Now, those kind of the high level thoughts on Buffett, Berkshire, and Omaha.
Okay. So one question comes to mind is as the economy is, well, we can get to the economy later, but the economy seems to be starting to slow, or at least the stock markets are alluding to the fact that it will slow. What do you do when, I assume you have a portfolio of investments? So what do you do in times like this? How are you looking at, let's take a hypothetical scenario, and let's say the market goes down for the next year.
Mhm.
And how do you look at a period like that as a value investor? Are you, well, I'll just ask the question. I'll come back with a follow up.
Okay, let me see. So, first of all, like I'm gonna refer to Stoic philosophers for a second.
Okay.
Okay, and and uh, and let's say when the market declines and it causes somebody pain. Okay, it doesn't to me, but let's say it does to somebody. They would ask you, "Did you really expect to invest in stocks and never see the market decline?" Right? So in other words, like if you are investing in stocks, so they would call it kind of negative visualization. In other words, when you invest in stocks, you need to be prepared for the fact that they will decline. That's number one. Number two, decline in prices means very little to me because it's just an opinion of the market at this point in time. Okay, it's not a final. For me, what really matters is has the value, the intrinsic value of the companies I own declined. And the market has an opinion on what my stocks are worth every single day, continuously throughout the day. And if I really cared about that opinion all the time, I would have even less hair than I have today. So what I really care is, so the value doesn't change much. It's the price does, but the value doesn't change. Has the value changed? And so when the market declines, what I look at this, and this depends how much cash I have. If we still have a lot of cash, I would be looking to see, which stocks now even cheaper than they were before. I'd buy more. If I'm out of cash, then I would be saying, okay, which companies are cheaper, the ones more expensive, and I would reallocate capital to the ones where the kind of risk reward is even more attractive now. So I look at it as a basic an opportunity, and I think that's the best way to look at it. This is why, anyways, that's the answer. Yeah.
Okay. So are you thinking about it from the standpoint of, do you have like a list of companies that you watch, and if one comes into range that is attractive for you, then you buy it? Because I mean, I look at the last 20 years, the early 2000s, the markets went down kind of gradually. 2008 was quite sudden. 2020 was sudden. And 2020, you would have missed it if you were kind of sleeping at the wheel with some of those opportunities. So how do you look at periods like that for yourself as taking advantage of that? Because even Buffett didn't take advantage of 2020 like he possibly could have.
Oh, that's right. Okay, so we look at it this way. First we look at our portfolio. Second, we have a watch list of companies we looked at in the past and said we'd like to own it, but not at this price. And if the company gets to this price, to that our target price, depends on how recently we looked at it. If you looked at it a week ago and suddenly the price dropped, then it would be a very easy decision for us. If you look 6 months ago, we may have to spend a little bit of time to do, to refresh, to see if anything changed. And we also have this kind of right now. I refer to what we're going through is kind of .com 2.0 time period. So a lot of technology companies that were darlings 8 months ago are down 70-80%. And so we are kind of going through them right now and trying to figure out which ones we want to spend more time studying, and a lot of them we looked at and realized there's a lot of more. Actually, so far, none of them were cheap enough for us to buy. So we still keep looking. Basically, right now we're spending most of the time on the .com 2.0 kind of bummed out, field. So yeah.
So you said you look for undervalued companies, but one of the challenges in periods like what I suspect we'll probably continue to see if it's like this is the prices go down, but then the earnings start to decline as well. If you George Soros talked about reflexivity from I guess Karl Popper originally. And that reflexivity of a bad market leads to a bad market, which leads to a bad market. So earnings decline. So how do you assess undervalued companies if you don't really know how that's going to be affected with the future?
Kirk, that's a great question. Well, number one, so when you say the future, to us, it's not next 6 months, but a long, long time. So we're looking 5 or 10 years out. So it's important to have the right time frame. Number two, like we have to normalize things a lot, and this is why this question is so important. Like right now, I'm just going to generalize, and I'm going to talk about this .com, kind of this digital companies. Like I'm just talking about digital companies. If you think about what happened during the pandemic, and this is very like I compare this to Y2K era of .com, kind of the first bubble, the first .com bubble. Let's kind of revisit 1999, 1978, 99. So in the late 90s, the the demand for technology was high. That created that basically attracted a lot of capital to the markets. A lot of new companies were formed that went out and bought a lot more technology, which created more demand in the technology, for companies, say like Dell and Cisco, right? So they benefited from that. Though those were real companies, but they benefited from the newly created demand from all these .coms. Now, then, for reasons that are still kind of elusive to me, everybody was worried about Y2K. So that when the clock changes to from 19 to 20, a lot of, I guess, mainframe computers will stop functioning and the world will stop. And so there was a huge amount of investment went into technology, probably a lot more than it should have. Okay, now this is very important to understand. If you were a technology company, let's say you're Cisco or Dell, and then for the previous 3 or 4 or 5 years, you had this insatiable demand. What you had to do, you had to create a cost base. You had to prepare your business for that demand to continue. And let's say your revenues were growing 30%, and you created your assets and your employee and the amount of employees you had was basically prepared, was tuned for that growth. Now, what happened though, a lot of the demand was temporary. Y2K demand was temporary, kind of one-time shot. And then 2001 comes, and you found that basically in 98, 99, 2000, you borrowed a lot of your future demand. And suddenly your revenue is not growing 30%, but they may be down 5 or 10. And suddenly you realized you have too many assets, you have too many people, and your margins compress. And so your earnings, instead of growing, actually decline. And so you have to go and right-size the company. And that's exactly what happened to a lot of companies in early 2000s. Okay, again, those are real businesses, and those businesses, like you look at Microsoft or Cisco's, etc., they actually continued to they had a reset for a year or 2, or maybe 3 years, and then they continued to grow again. I would argue that the pandemic was that for like the Y2K for a lot of those digital companies. Like the advertising revenues during the pandemic were probably too high. Like Zoom, for instance, and I'm just mentioning names without really, just kind of on a high level. Zoom, for instance, probably got to the maturity in a year and a half. It's kind of, it's had an accelerated, it's accelerated from a kind of adolescent to, not quite to retiree, but close to it, like in two years. That's what pandemic did. So when we look at these technology companies today, we have to be very careful to recognize a couple of things. That probably last couple of years were an aberration, and that in fact, if you look at a lot of revenue growth, looks like this, like it was going, and it suddenly does the hockey stick thing. We have to normalize that the revenues for the last couple of years probably were too high. The margin, and that over the next couple of years, their margins are going to, probably going to look horrible. And this is why the stocks will get when I look at the sector today, my gut feeling tells me that the stocks will, the stocks will mean revert a lot more, and the carnage in the industry is not over. So we've been very patient, and we are just kind of doing the research one stock at a time and trying to find the best diamonds in this, minefield.
So yeah, and I appreciate that. That's a great answer. What, how do you manage risk in a time like this? Because you're talking about having cash, which I think is great, but obviously you have to plan for that. So how do you manage risk in bad times as well as just normal times when the market's not imploding?
Well, I think you and I have to agree what risk is. Okay.
Good point. I like that.
Okay. Yes. To me and to my clients, it means permanent loss of capital, company declining and never coming back. Yep. That's a true risk. You can also argue that the risk is a loss of purchasing power over time. So that's another risk.
Yep.
But the portfolio declining in price, just being marked down by the market, is not a risk to me. It's a lot of times there's an opportunity, or it's just a kind of it's a cost of playing in the stock market, basically. Well, I shouldn't say playing. I don't like using playing because now it's investing in the stock market. So how we plan for risk? So our cash is not per se byproduct of us trying to time the market, because it's very difficult to do. To time the market, you have to get two things right. You have to get the economy right, and then you have to get how the market will respond to the economy, which is, what I learned is that it's such a complex system that a lot of times, in the hindsight, it makes sense. But let me give you one tidbit, just like how I'm going to get off topic for a second. When Russia gets sanctioned by the rest of the world, where companies are leaving Russia, and everybody's trying to buy less and less of its petrochemicals, you would expect the Russian ruble to collapse, right? That's a rational thing. In fact, I had a friend of mine who had a huge exposure to Russian market, and he hedged by going short Russian ruble, which is logical, except ruble today is more expensive than it was before the invasion. Yep. Just think about this, and you think, how could this possibly happen? Well, it's very simple, because it's an export. In hindsight, it's like, it looks obvious to me now. At the time, I was in the camp that ruble will collapse. It's very simple. You have exports that are still continuing, and imports. Well, since imports basically almost stopped because nobody allowing Russia to buy anything outside of Russia, therefore, the demand for rubles are higher than demands for dollars. So the ruble is actually appreciated. So do you see how timing these things, so this is why it's a complex system where analyzing individual companies, to me, is a lot less complex, or valuing them. It's a level of complexity. To me, valuing a company is a exponential lower than me trying to figure out what the stock market is going to do in the next 6 months. So our cash is byproduct us making a lot of individual decisions that are not complex. Okay. And then if we have enough if we can find enough high quality companies that are undervalued, then we'll be fully invested. We're not gonna have any cash. If we can't, then we're gonna have cash that's gonna be waiting for opportunities. So that's how we manage risk, is by trying to make the best decisions we can, and only buy things that are high quality, undervalued. And that's so. It's kind of interesting, actually. It's almost like addition by subtraction, in the sense that you make uncompromising decisions in your portfolio, and by doing that, first of all, you're creating a cash balance which you can use in the future. But second of all, when stuff hits the fan, you haven't compromised on what you owned, what you bought, and therefore it's going to handle the adversity, whatever economy presents, much better.
Yeah, no, that makes a lot of sense. What one question I had is, do you have favorite sectors based on their, I guess, business model, if you will, in terms of just profitability or cash flow, or what are kind of your favorite sectors?
Okay, let me describe you my dream company.
Okay,
we have a cash light balance sheet, have a lot of cash, great management, high recurrence revenue, where they turn on the light, like every year they would know how much money they're going to make the next year plus. Would have a high return on capital. It would not be very cyclical. So this is my dream company. The reality is that it's very difficult to have a portfolio just of this kind of companies. So the way we try to get as close to it as possible, but realize that to get this doing companies at great prices is just almost impossible when you have a portfolio of them. So we have sectors that it's easy to say what we don't like. I don't like highly cyclical industries, and I don't like them in part because my investment EQ is not very high when it comes to cyclical industries. Okay, number one. Number two, a lot of time I don't like I don't like businesses that are also capital intensive. So like if you look at mining companies, for instance, not my favorite companies. I don't like companies where I have to be very, very smart, where especially when I have a confession to make. I was not a very good student when I was in high school. So biology was not good at that. So if I had to look at the biopharmaceutical company where it only has 1 or 2 drugs that requires me having a PhD in biology, probably not the right company for us. So it's also a lot of so what's important, in this answer is to know your limitations. Okay, know your circle of competence. If your listeners and viewers have a PhD in biochemistry, they probably they should do the opposite of what I'm doing, and they should be spending more time in with biopharmaceutical companies. But it's if your viewers are very comfortable with cyclical businesses, then they should be doing the opposite of what I'm doing. So I'm just giving you. It's very important to know your limitations and where your IQ is high, where your IQ is low, and same thing for your EQ. And that's so the portfolio we have today is a reflection of my strength and weaknesses.
So one thing that comes up, and you kind of mentioned this when you defined risk, permanent loss of capital and loss of purchasing power. The second being the more pertinent now, since we have recent history would suggest is very high. Yes. And how are you managing money, or at least what is your thinking around the inflation topic now, and how maybe I don't know if we're changing a paradigm from the way things used to be?
Yeah, no. So I just wrote an article about this, where I basically talk about, I've been writing about inflation for the last year and a half, maybe the last 2 years, So it's almost like a continuation of my previous articles. But I'm basically, today we have because of the war in Russia and Ukraine, we have additional sources of inflation that did not exist 3 months ago. I think one of them is an additional pressure on petrochemical, on oil and natural gas, because Russia basically produces about 11 million barrels of oil a day, and a lot of it is going to go away from the market. Considering that oil prices were very low even before the pandemic, and low oil prices basically are stimulative to new investments. And you had a pandemic on top of it where you had negative oil prices for a few days. We already had a kind of limitations on our oil supply. So now we add in another stressor on this. So I think oil prices will most likely continue to stay high or even go higher. And so are natural gas prices. And you can throw ESG into this whole thing, which made the supply situation even worse. So you got that. Then you have the food inflation, and Russia and Ukraine are one of the largest exporters of wheat. But that in itself, they're responsible for about 7% of the exports of global consumption. So they export 7% of global consumption. That in itself is not as big of a deal because that's a kind of typical volatility in the wheat market. So we can handle that. We may have some inflation from that, but not a lot. Where the inflation is going to come from is that fertilizer prices are going through the roof. Potash, where Russia and Belarus are the second and third largest exporters, is doubled, tripled, or quadrupled since the start of the war. Also, nitrogen fertilizer, which is basically derived from natural gas, those prices skyrocketed as well. So what that means is that the farmers either going to plant less, they're going to use less fertilizer, and so the yields are going to be lower. So there's a good chance we're going to have, going forward, a significant food inflation. So what we've seen is not over. Like, it's going to get worse. The food inflation will get worse. Then we have interest rates going up, and higher interest rates. Like what's important to understand, it's not just that the interest rates are going up, is that we had such a low interest rates and we have borrowed so much more because of them. Is that when your mortgage, the interest, I'll give you an example. 30-year mortgage, I don't know, 3-6 months ago was at 2.7%. Now we're at 5.2. That is on average house. I think I forget the number, but I think median house in the United States now is about $450,000. That's that increase in interest rates cost consumers $7,000 more in just interest expense. I want you to think about this for a second. The same house you could have bought 4 months ago. If you buy it today, you have to pay $7,000 more. And I'm just talking about interest expense. So you pay more for the same. And by the way, the same is going to apply to cars. Anything that has to be financed is going to become more expensive. And that is actually, first of all, by the way, so that also, the rents are up as well. So everything is going to cost more. Okay. And everything costs more and at the rate faster than wages growth. This point is very, very important. I think the wages grew about 4%. Like from my memory, I think 4% last year, where inflation was, I think government numbers 8 or 9. But if you look at the export-import prices, those numbers are between 12 and 18%. So, but let's stick to the government price. Let's say the inflation is 8 and the wages growth is 4. That 4% difference means that your discretionary income has been robbed by inflation. And that's how inflation turns into stagflation. This is how people basically have less money to spend to buy discretionary goods. and this is how we go into, how economy slows down. Are we going to go into a recession in the sense that we're going to have two negative GDP growth, quarters of GDP growth? I don't know, but that's not important. What's important is we most likely going to enter into slower economic growth going forward. And let me give you this perspective. Somebody asked me, well, how do you invest in an inflation environment? Oh, what does it feel like? And somebody says, should I go back and read this 1970s and 80s books, history books? And you can do this, or you can just, whatever happened in the last 20 years, just invert it. Okay.
Yeah.
The housing prices were going up, so we had a lot of consumer confidence. We were spending, consumers were using houses as ATMs. Well, that's going to, if housing prices decline, which I think that's probably already started to happen, that means people feel poorer. The equity is declining. That means just, the opposite is happening in these Home Depots and Lowe's, etc. And so just think about if you had interest rates were going lower, so price to earnings were going higher. Well, now we're going to have inversion of that, and most likely price to earnings will be declining. So as an investor, you want to make sure you have a significant margin of safety, in your stocks. In other words, the discount to the fair value should be even greater now. You demand a greater discount than before. Anyway, so this is kind of those are my thoughts kind of on the economy and inflation.
Yeah, no, that's good. I like that. So, I mean, I've been talking about a lot about inflation lately because it's such a big topic. I've kind of distilled things down to really a single question, which is, inflation is really dependent upon the Fed. And I think the question is, if the Fed is backed into a corner, right, they have to make a decision. Do they protect the economy or do they fight inflation? And I guess in your opinion, which one do you think they would choose, if they really were cornered and had to make a choice?
I almost don't see it this way anymore, because they only have one. Like, let's try to, so let's say the economy rolls over, right? And they lower interest rates. They would just make things worse because the inflation will be even greater. Right? So think about this. Over the last 20 years, every time there was some kind of hiccup in the economy, Federal Reserve would come in. As if we're about to feel pain or we start to feel pain, they would come in and just inject a whole bunch of steroids into us. So the pain, we kind of did not really experience full pain. But that pain did not really go away. It was just got bottled up. It just got bottled up every single time. The jar is now full. Okay, there is no more. You can't add any more. Like, Federal Reserve at this point cannot really relieve the pain anymore. So now that in fact that the jar is now leaking. And what I think is going to happen is that for the Federal Reserve to basically make sure we don't have hyperinflation and the dollar is still reserve currency, they're going to have to raise rates. Because, by the way, because the dollar is going to crash if they don't. And if they raise, and we're going to have, this is why I'm so, I think we're going to have a slow economic growth. Again, this is an important point to understand. I sound extremely negative. And I'm quite aware that the economy is a complex system and I could end up being completely wrong. But like the way I look at it, clients hire me for to make sure I not just grow the capital, but also preserve. So, so my job is kind of hope for the best, for the best, and prepare for the worst and hope for the best. So since hope is not a strategy, I focus on the preparing part. So this is why when I sound negative, I'm sure there's a lot of offsetting arguments to what I said that could be more positive. But I'm just from portfolio construction, I'm preparing for a more difficult environment, which is a high probability, but it's not a certainty.
Yeah. No, I appreciate that perspective. And I know we're kind of running short in time here. So I we'll probably have to have you come back on because I don't think inflation's going away.
Now we have inflation of time too. So
yeah. Well, one question I would ask you before you leave is, what to you is a meaningful life?
It's almost like the life I'm leading today. There's so many ways to answer this question. Okay, so to have people you love in your life, to have a healthy dose of creativity, because that's how my batteries get recharged. To wake up in the morning and look into spending the day doing things you love. Those kind of like, like if you ask me that in the next interview, the answer will be different. But and just also kind of being in a, being comfortable with yourself. Like, it's a kind of, this is why Stoic philosophy becomes very important. It's just kind of to manage the downside, kind of negative volatility. And also another thing is kind of being net positive to society. This is why, like, I just, this book I just wrote, this Soul in a Game, The Art of Meaningful Life, I don't think I ever cared about it. Like, I want this book to succeed. Financially, it's not gonna make a difference. If it becomes Harry Potter, my life will not change a bit. The reason I wanted to succeed because I got people who read it so far, the feedback they gave me, they said it made a difference in their life. Just it improved it. And to me, that is, I'm too young to think about my legacy, but maybe not too young.
Never too young.
Yeah, I guess you're never too young. And to me, that means that I'm doing something meaningful. That if I have a net positive impact on other people, that is such a privilege, I guess. That's what else can I ask for? So that's, it's never just one answer, but it's a combination of many different things.
Yeah, no, I appreciate that. Well, Vitaliy, I really appreciate you coming on the show, and I know you've put out a lot of great content around this and a lot of different ideas. Where can people find more about you?
Okay, so unlike your wonderful podcast, I have a lazy man's podcast, which is basically my art. I write these articles, and they are read to you by a professional, reader. So like, think about these articles on tape. So if you go to investor.fm, like almost like FM radio, investor.fm, that's one place to get it. Another one is I have a website where you can read my articles and sign up to receive my articles by email, which is contrarianedge.com, contrarianedge.com. And finally, my book, which is coming out in June, you can find it on a Soul, SOUL, inthegame.net. soulinthegame.net. So, yep, those are the 3 websites.
Great. Well, like I said, I appreciate you coming on the show. I know you put out some great content, and highly recommend, people are interested in value investing, which I would imagine should do quite well in the coming times. I recommend reading it. So,
Kirk, thank you very much. And you have a wonderful podcast. Thank you for having me.
Great. Thank you again. We'll have you on in the future for sure.
Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Vitaliy. I really appreciate him coming on the show. He's got some excellent work. So if you haven't seen it before, highly recommend you sign up for his newsletter. He writes some great stuff and is a very thoughtful guy. So now we get into the panel portion of the show. We have our very own Megan Gorman. Hey, Megan.
Hey, Kirk. How you doing today?
Doing great. Doing great. And we also have our very own Barb Friedberg. Hey, Barb.
Good morning, everybody.
Good. Well, glad to have you both here. So let's just dive right in. So, Megan, what were some of your takeaways from the interview?
First of all, I think that this area of investing is getting a lot of press right now, right? And for a long period of time, we were in a very much a growth market. And I say this as someone who constructs portfolios that have both value and growth in them. And, at times people ask, why do we have the value component when growth is doing so well? But I think for most investors, even though you might want to have a value tilt to your portfolio, I always caution it's really, really important to remain diversified and think through how you want to layer this into your portfolio. And there's a bunch of different ways to do it, but it isn't just going out and picking one or two stocks from my point of view. I think it's taking sort of a global look at the entire market, not just the US large cap market, but the US small cap market and the international and emerging markets. So it is a global approach that I would encourage people to take if they want to add value to their portfolio.
Okay, great. So Barb, what about you? What were some of your takeaways?
I've been reading Vitaliy for years, so it was really nice to hear his viewpoint in person. And although at my core, I'm a value investor, I have to concur with Megan because markets are cyclical, and value investing, which means trying to find the true value of a company and then investing in those that have a price that is lower than their intrinsic value, is the goal of value investing. And over decades and decades, that strategy has outperformed. But as we've seen from 2007 to 2020, it failed miserably. Mm-hmm. So number one, you have to have a mix of value and growth investments in your portfolio, funds, individual stocks, or you will be very lopsided when growth is outperforming versus value, or value is outperforming versus growth.
Yeah, agreed. So let's just kind of dive right in. Let's ask a follow-up question for you, Barb, because you're a former portfolio manager. How are you looking? Megan mentioned portfolio construction. How would you look at that? I mean, you're a value investor, but you're saying, hey, we should have some growth in there too. Like, how would you look at it right now that people can take away from this?
Well, I have throughout my portfolio, ever since I've transitioned from being predominantly a stock picker to being predominantly a passively managed index fund investor, I have a tilt. So in my portfolio, I have several value exchange traded funds. And that is for those of us that are not stock pickers and don't have the time or resources or interest to pick stocks anymore, buying a value ETF or mutual fund could be a passively managed one. The most popular is Vanguard's Value ETF, VTV. They have mid-cap value, they have small cap value, or there are actively managed value funds. I think that's a wise addition to any fund because in general, unless you're invested in a small cap fund, most of the large cap funds are dominated by growth stocks. And that includes your market capitalization weighted index funds because by their very nature, by their weighting, market capitalization is stock price times number of shares. The more quickly growing companies are going to comprise a larger percentage of the value of that fund. So to balance that off, I like to throw in, whatever percentage you think is appropriate, 5, 10, whatever, just to cover the value sector. And we're seeing value is performing better than growth now. And although some reports say it will continue to outperform, we don't know.
Yeah, I think one of the problems I have with the portfolio construction, especially with the growth versus value, is how do you constitute what's growth and what's value? I mean, was it 2 weeks ago? I think Russell came out with their index and they're adding Meta to their value index. I thought that was a FANG stock. I guess it's no longer a FANG stock. I guess now it's a value stock. But those questions come to mind, right?
Well, let me interrupt you because okay. I have not studied the fundamentals of Meta. So I can't respond to that in a specific sense. But for example, if Meta's, maybe it's still growing at very rapid paces, and that typically will constitute a growth stock. But if it's growing in rapid paces, 15% or more, which again, I don't know if it is or not because I haven't studied it. But if the price has fallen enough by typical valuation measures, ratios, which might be your price earnings ratio or your growth to sales ratio or your free cash flow ratio or your debt to earnings ratio, if those have fallen enough, that could put a former growth stock into a value category.
Yeah. No, I think that's, go ahead, Megan.
No, and I just want to jump in here. I know it's important to think about and have this debate for our listeners about things like Meta, but I don't want to get so far into the details that we lose sight of things, right? So one of the things I think it's more important for investors to do is really understand where their portfolio is positioned today, right? And there's weight tools out there that they can use to understand where the underlying tilts and, are they growth oriented? Are they value oriented in their portfolio? And so anyone listening today, I would advise them, regardless how you feel about growth, regardless how you feel about value, go on to Morningstar and use the portfolio analyzer. And I think really start to understand, how is your portfolio positioned, right? Are you overweight value? Are you overweight growth? Are you overweight value in the small cap area, right? And what does that mean, right? Because if you have a significant overweight to value in small cap, while that means you might have a deep value tilt that can give you great long-term returns, you're going to pay for it in volatility over the short term. And so I think the thing is, stay big picture with your portfolio, understand how it's positioned, and then ask yourself the questions of, am I comfortable with this? Because I believe most investors out there, when it comes to this, are probably best suited to an all cap value ETF that gives them broad exposure globally in value, but doesn't take on any unintended risk where they can't weather the volatility. So I think, Barb, you're probably on the same mindset as I am about this type of stuff as well. But I think that the Morningstar tools are incredibly important to use here.
Just real quick, it's called Morningstar X-ray. It's awesome. But I'm going to deviate just a bit because small cap value over time, and I'm not talking 10, 15, 20 years, I'm talking 50 plus year, has been a stellar performer. Now, will it continue in the future? I don't know. But if you want to have a tilt beyond an all cap value, you might want to play the data and put a small allocation in a small cap value. Other than that, got nothing else to say.
Yeah, and well, and if you want to understand more about what we're talking about here with small cap value, the good news is there's tons of academic research on it, and there are actual mutual fund companies that have been built on the research. So, just a basic Google search will take you to these companies like Aventis, DFA, where they can lay out the academic principles, and you can see if that aligns with your investment values. Just because it's academically proved to be one thing doesn't mean it's the right fit for your portfolio.
Right. And it also doesn't mean just because it's academically proved that it's actually true, right? We've seen that over the last 20 years.
Or past performance is not indicative of future, right?
Right.
Exactly.
Yet everyone focuses on it.
Knows the future. Nobody. And Rick Ferry, a guest of ours, a fabulous passive index fund investor, said it so well every time you asked him about a future leaning question. His answer was, I don't know the future.
Yeah.
And even the pundits don't know the future.
Especially the pundits. I think we probably know the future better than they do, at least by their track record. I couldn't agree more. I think, the point I was trying to make about the index is you should always know what you're investing in. Because if they're reworking these indexes right in the middle of a bear market or a market sell-off, now you have a different construction and it may not operate the same way it has been. So you should always know what you're investing in, whether it's going to Morningstar or what have you, but just understand, are you actually investing in a value index, or is it some rework that is going to operate differently now? So good things to keep in mind. So So Megan, when you're looking at portfolio construction, are you looking at ratios and metrics, or how does that kind of play into portfolio construction for you?
In terms of how much percentage we want in value versus growth?
Yeah, if you're doing tilts or things like that, basically, how are you coming up with the tilt? Is it based on valuations? Is it based on other metrics?
So I do have a chief investment officer who handles the actual technical aspects of it. But when you look thematically at our portfolios, what you will typically see is something that's pretty standard in portfolios, which is a core complement approach. So typically in each asset class, we do have a core holding. So take large cap as a good example. We will have the S&P 500 or an S&P 500 like investment. And then we'll toggle it on both sides by a value fund and a growth fund, right, in order to get the different exposure. And what we focus on in those two funds that we toggle with is the concentration of the holdings in those funds. Because again, we want to make sure that if value has a great run, we're able to participate in it. But again, we're trying to manage risk overall in the entire portfolio. So we're not going to be a pure value investor. And by the way, these are discussions we have with clients. Like, we have some clients that are like, look, I don't want anything to do with making significant investment decisions. I trust you and your process, and I go with that. We have other clients where there is a debate, and then we can layer on things like value or a quality value tilt that they want in order to pick up certain returns. But I often explain to people that when you are building a portfolio, it's an art, but it is a little bit of the science of like being an auto mechanic and being under the hood and sort of playing with the mechanics a bit to get the result that you are seeking. And we don't know how the result will play out, but we can design a portfolio and tell you how it will play out in certain markets. And so that's sometimes the data that a client needs in order for them to weather certain market cycles. But it's, it's a tough balance. But I would tell you the majority of our portfolios are balanced between growth and value.
Okay, that's fair. So Barb, what about you? What kind of ratios you look at, metrics, how are you looking at that in making your determinations as a former portfolio manager?
I have just set up an asset allocation that makes sense for me. And I recommend that, as we all discuss, if you're doing it yourself, if you're a DIYer, figure out what amount of risk can you tolerate. For example, you know that a diversified all stock portfolio has the potential to drop 20, 30, or 40% in a year. We're living in that time now. We are in a once in a many decades time where bonds are also declining. This is rare. It's a 1 in 10 occurrence. It typically does not happen. So don't freak out that this will probably happen over and over. It may not. Okay. I don't want to say definitely won't. And then you need some cash to, emergencies to kind of balance out the stocks. Bonds, cash, maybe you have some real estate. So that's called your asset allocation. And you can totally forget about value and growth if you just want to go a simple route and just, because there are some value stocks embedded in every fund that you invest in, unless it's a solely growth fund, if you're index fund investing. But if you want to have a tilt, like we've been discussing, like Megan mentioned, put 5-10% in value ETFs. If you believe the research and you believe it will continue, and it just depends how deep you want to go. You can get a perfectly diversified portfolio with 3 to 5 index funds, 3 to 4 index funds. Or you can go way in the weeds and choose 5 to 10 and diversify across niches, segments, different strategies. Or you can just throw your hands in and hire a financial advisor or invest with a robo-advisor. So it's a personal decision depending on how much you're interested in investing, how much you want to do it yourself versus how much you want to turn over to someone else. But I implore you, if you are doing it yourself, don't go in blind. Spend some time reading well-researched investment books and articles to help you form your own investment strategy.
Yeah, and I want to appreciate that, Barb. I want to ask you a follow-up question before we get close to wrapping it up here. If you look, I know you're a spring chicken, but I'm sure you remember the 70s, right? Which was a very interesting period. And one thing I noticed as I was kind of doing my research in the last 6 months is that the nominal valuations of the market bottomed in, I think it was 1974. Yet from a valuation standpoint, they've bottomed in 81. So I don't know if you're familiar with that or if you want to talk to it, but I think it's an interesting perspective that I think will be lost on most people because most people look at prices from a nominal perspective.
Okay, let me explain what Kirk's talking about, because valuation is typically, are you talking about valuation of price earnings ratio of the overall market?
You could use PE, Q ratio. I mean, they're all similar in that they reflect the same thing.
So nominal means in name only. So what Kirk is saying, it bottomed out. It hit the bottom dollar amount. But if you look at not the dollar amount, and this is really important for investors to understand, a valuation metric calculates how cheap or expensive a stock is based on as quantifiable data as we can get. Frequently, we use the price earnings ratio, which is the price divided by the prior earnings, or there's other iterations of that. So Shiller.com has some great data on that. You can pull up what the valuation is, compare it with historical valuations. And price really doesn't tell you much except what someone's willing to pay for it. It's not necessarily a reflection on the value of the company or of the market. So I didn't answer your question, did I?
Nope.
What the heck was I'm so busy talking about explaining what these things mean. I completely forgot your
No,
question.
that's good. I appreciate that. I think people need to understand the terms and the construct. So my question was this, is that in 1974, market prices bottomed from a nominal perspective. So from a flat dollar perspective, they bottomed in 1974. But from a valuation perspective, looking at the market as a whole, the valuation bottom was in 81, meaning that was the cheapest valuation you could have gotten a company, even though technically the price was higher, the valuation was also stronger. So I don't know if you can talk to that at all.
Okay, so my response to that is that it's really important to understand the valuation of what you're buying. And price is, a part of that, but it's not the answer. So a stock can be highly valued and low priced, or low valued and high priced. And so I just suggest you look at general valuations. If you had looked, December 2021, and you would have seen the market was very overvalued by, let's just use the price earnings ratio. The value was among the highest it has been, with the exception of 2000, which means you were paying a lot of money for $1 of earnings of a company, or if you're looking at the aggregate, the S&P. So you're buying things that are very highly priced. Now the valuations have dropped, and the value of the companies are cheaper. Are they at historical averages? No, they're still more expensive than the average valuation. So don't get caught up in price, is my last analysis. Understand the valuation of the market of the stocks you're buying and the time in which you're buying. If you knew the valuations, you would not be surprised that the stock market was due for a tumble. Now, stocks can remain overvalued for years, as they have been over the last, Kirk, Megan, maybe 5+ years. They've been trading at higher than their historical averages, but at some point, they're going to revert to their mean average or fall below that.
Yeah, no, I appreciate that, Barb. That's good perspective, and we'll definitely be talking about that more on the show, because depending on the metric you use, I mean, if you use like a Q ratio, which I kind of like, I mean, it was the highest ever most recently, and it's still quite high, in historical perspective. But we'll put some charts in the show. Go ahead, Barb.
Yeah, what I would love to do, Kirk, if we could do this sometime, would be to show some charts while we're talking, switch over to screen sharing, show our listeners who are watching on, or our viewers who are watching on YouTube, what the charts look like, so they can see the valuations of the stocks and compare price and valuation, because I think that's a really interesting distinction.
Well, fortunately,
equal value.
Fortunately for you, Barb, we have a magician behind the scenes who's going to make all those charts magically appear on the screen for all our YouTube viewers. So if you're not watching on YouTube, please go to YouTube to check this out. You'll see all the charts that we're referring to, and I think it'll help you put things into context.
I love magic.
All right, well, that's it this week. Barb, final thoughts from you.
Yeah, know what you're investing in. Investing's not a game. It is an activity that it's a place you can put your money to help it make more money. Plain and simple. It is not a game. So take it seriously. My name is Barbara Friedberg. You can find me on YouTube, Barbara Friedberg Personal Finance, and at Robo Advisor Pros. Bye.
Thanks for coming on, Barb. And Megan, final thoughts from you.
Yeah, I mean, value investing is something that you should consider for your portfolio. But what I really urge everyone to do is do a deep dive, understand where you're invested in the investment universe, and try to look at that and make decisions on how you want to layer in things like value, like growth, right? To really understand where your risks are going to be. And it sounds boring, but an all-weather portfolio is often the best course of action for most investors. So I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Kirk, thanks for having me on.
Thanks for coming on, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.